Foreign earned income exclusion. So it's time that we make a video talking specifically to the people who are US citizens, but they decided to take a job in a foreign country. Because let's face it, when you decide to take a job opportunity in another country, it's usually because that job has decided to pay you a lot of money. And of course, the more money that you make, the more money you are usually taxed, right? Well, not exactly. So there is something that is called a foreign exclusion that can help you avoid paying taxes on certain income. So in this video, I want to talk all about the foreign earned income exclusion so that I can help those people who are working out of the country maximize their tax liabilities and their tax strategies. Stay tuned. Hey there and welcome to the channel. I'm Sean with Life Accounting, the accounting company that saves people from high taxes and low profits. Now, if you find any value from this video, please do us a huge favor and click that like button for the YouTube algorithm. It really helps to spread this video to more people like you who want to learn about the foreign earned income exclusions, and it also just makes us really happy. So thank you for clicking that like button. Okay, so today we're going to focus on foreign earned income exclusions. And of course, we have to first talk about what is foreign earned income. So foreign earned income is simply income you receive for services you perform in a foreign country during a time when your tax home is also in that foreign country. So in the foreign earned income exclusions, meaning that you do not have to pay US federal income taxes on that foreign earned income, which again is money that you made while you were basically out of the country. Now, there is a limit on how much foreign earned income can be excluded, which in 2021 is up to $108,700. But in general, it's always been somewhere between $100,000 to $110,000 in the last few years. So, for example, to give you guys a real case, we once had a client who worked in Kuwait as a contractor, and what he did was he helped with the extraction of oil from the ground. He made a healthy 6 figures doing so, but he did not have to pay a huge amount in taxes because he used the foreign earned income exclusion. And there are basically 2 tests that you can try to pass that will confirm your foreign income status, which we'll talk about here in just a second. But first, let me talk about what is classified as earned income and then what is also classified as unearned income. And this is really important to know whether you are working in a foreign country or not, all right? Knowing the differences between earned income and unearned income are important. So earned income would be stuff like salaries, wages, commissions, bonuses, professional fees if you're a contractor, and any tips that you receive. Okay, that's basically money you actively earn. Unearned income would be stuff like dividends, interest, capital gains, gambling winnings, alimony, social security benefits, pensions, annuities. And as you can tell, unearned income is more like passive income. Now, there's one other type of income that we're going to talk about, and that is variable income, which would be stuff like business profits, royalties, rents, scholarships, fellowships, etc. And these could fall in either the earned or unearned income category, depending on how the money was made. So that's a general high-level overview, but there are still some exceptions of things that are not included in foreign earned income. For example, if you receive pay as an employee of the US government, like you're in the military, for example, that is not considered to be foreign earned income. Or if you work in international waters or airspace, but your primary job is located in the US, that is also not considered to be foreign earned income. Unearned income could also be stuff like the value of meals that your employer pay, right? So that also would not be eligible for any foreign earned income exclusions. All right, so the key takeaway here is that yes, there are some exceptions for foreign earned income exclusions, even if you technically work and live in another country. Now let's go ahead and talk about the two types of tests that you have the options to pass that will basically prove with high certainty that you do indeed qualify for foreign earned income exclusions, which again basically means you do not pay taxes on that foreign earned income. The first test is called the Bona Fide resident test. So first off, this test only applies to US citizens or US resident aliens who are also regarded as US citizens. Okay, you can pass this test if you are a bona fide resident of a foreign country or countries for an uninterpreted period of time, and that includes for the time period being an entire tax year. Now, the key word here is uninterpreted period of time, because if you go to work in a foreign country for a specific period of time, you would ordinarily not be regarded as a bona fide resident of that country, even if you worked there for one full tax year. So with the bona fide resident test, you are basically taking a job, you plan to actively work there without plans to specifically leave by a certain period of time, and you plan to stay there for at least one tax year. If you do all of that, then you pass the bona fide resident test. Now, if you are audited, they will make a determination of if you qualify by looking at your specific situation, such as your intention or purpose of being in that foreign country, your activities while you were inside of that foreign country, and whether or not you actually paid taxes to that foreign country, just to name a few determining factors. So you can't be overseas or out of the country just enjoying a vacation. They will audit and look at exactly what you did. The second test is called the physical presence test. So this one is a little bit easier to understand. You simply need to be present in a foreign country or countries for a full 330 days during a period of 12 consecutive months. So unlike the bona fide resident test, with the physical presence test, it does not depend on whether or not you establish a resident. It does not depend on your intentions about returning back to the US or your purpose for being abroad. Again, you simply need to prove that you are in a foreign country working for a full 330 days. That means you would have roughly about 35 days where you could be physically present in the US. And just as an important side note, a full day is clarified as a full 24 hours. So if you were thinking about working like a half day and then coming back to the US, that would technically use up one of those 35 days that you have. All right, so at this point, you should know what foreign earned income is. You should know what the foreign earned income exclusion is. And then you should also know the differences between earned income and unearned income. And lastly, you should know the two tests that you can use that would help you qualify. Now let's bring this all home by looking at a foreign earned income exclusion example using the bona fide resident test, so you have real numbers and can try to do your own calculations. Here's an example directly from what the IRS gives us. So say for example, you are a US citizen who is a bona fide resident in a foreign country and working in that foreign country as a mining engineer, and your salary is $76,800 per year. In addition to the salary, you also receive a $12,000 allowance for the cost of living and education in that foreign country, and your employment contract did not indicate that you were entitled to these allowances only while outside of the US, which is very important. So that would make your total income $88,000. So think about it like this. You go to work 5 days a week, Monday through Friday, and after subtracting your vacation, you have worked 240 days that year. And on top of that, you also have maybe 30 work days in the US. So to figure out exactly what US income is taxed, you would take the 30 work days in the US and divide it by the 240 work days in the foreign country, and then multiply that by your total income. And you would end up with about $11,100 being taxed as US income. So right there, you have a real calculation. Now, if you still need some help determining your status and trying to run some of your numbers, you can also use a tool on the IRS website called the Interactive Tax Assistant to help determine whether or not your income earned in a foreign country is eligible to be excluded from income reported on your US federal income tax return. So I'll go ahead and put a link to that assistant in the description below. But hey, if I do forget, we make these videos completely for free. You can just Google the tool and you should be able to easily find it as well. All right, so that's all I have for today. As always, thank you so much for watching. We have 2 more videos coming up next, so if you haven't checked those out, make sure you do, and we'll see you over there.